Something critical just changed inside the U.S. financial system, and almost nobody noticed. No emergency press conference, no bold headlines, no warning to the public. But on the first day of December, the Federal Reserve quietly brought a 3-year policy experiment to an end. An experiment that shaped inflation, interest rates, and the cost of everyday life for millions of Americans. That policy was quantitative tightening, and its ending signals something far bigger than most people realize. This wasn't just another technical adjustment. It was the clearest sign yet that the Federal Reserve is preparing for the next phase of the economic cycle, a phase that will affect the value of your money, your cost of living, and the long-term stability of the economy itself. At a time when Americans are already stretched thin, this shift couldn't come at a more fragile moment. Interest rates have fallen into the mid-3% range, the lowest level in nearly 3 years. Unemployment has drifted upward toward 4.4%, giving policymakers cover to loosen financial conditions. And while official inflation numbers suggest things are cooling, the lived reality tells a different story. Groceries, rent, insurance, utilities, all remain 20 to 30% higher than before the pandemic. Prices didn't reverse, they reset. And that reset is the foundation of what comes next. By the end of this video, you'll understand why the Federal Reserve ended tightening, what it signals about the future, and why the next phase of this cycle may be quieter, but more dangerous than the last. What quantitative tightening really was. For the past 3 years, the Federal Reserve was doing something rarely attempted at this scale. It was removing money from the financial system. Through quantitative tightening, or QT, the Fed allowed trillions of dollars in maturing bonds to roll off its balance sheet without replacing them. That process drained liquidity, tightened credit, cooled lending, and made borrowing more expensive across the economy. It was the Fed's primary weapon against post-pandemic inflation. When QT began, the Fed's balance sheet stood near $9 trillion, swollen by years of emergency stimulus. By the time QT ended, that number had fallen to roughly $6.5 trillion. On the surface, that sounds dramatic, but in historical context, it isn't. Before the pandemic, the balance sheet hovered closer to $4 trillion, which means even after 3 years of tightening, the financial system is still operating with trillions more liquidity than it once did. And that excess matters, especially now. Because at the same time the Fed was draining money, the U.S. Treasury was issuing massive amounts of new debt to fund government spending. Banks and institutions can only absorb that supply if there's enough cash in the system. Over the past year, cracks began to form. Funding costs rose. Bond auctions weakened. Short-term markets showed signs of stress. These are not signals meant for the public. They're warnings meant for central bankers. The Fed saw them, and they remembered what happened the last time liquidity was drained too aggressively. In 2019, the repo market froze. Overnight lending seized up, and the Fed had to intervene immediately to stop a broader financial breakdown. This time, they chose not to wait. Ending QT wasn't optional, it was preventative. Why pausing QT is a bigger deal than it sounds. To most people, ending tightening sounds neutral, but in monetary policy, stopping the drain is the first step toward refilling the system. Historically, whenever the Fed pauses QT, the next stages often include targeted liquidity injections, short-term bond purchases, balance sheet expansion under a different name, not always immediately, not always loudly, but the direction matters. The breaking phase is over. The reset phase has begun. How money is actually created. Most people imagine money as something physical. Cash, coins, numbers in an account tied to real value. That's not how the modern system works. Money today is created through lending. When the Federal Reserve wants to stimulate the economy, it doesn't print bills. It buys government bonds from banks and financial institutions, paying for them with newly created digital dollars. Those dollars enter the banking system instantly, and banks don't sit on them. They lend. Mortgages, business loans, credit lines. Every loan creates new money the moment it's issued. This is why economists say debt is money. When borrowing slows, money creation slows. When lending tightens, the economy feels it almost immediately. During the pandemic, borrowing exploded. Between 2020 and 2022, the money supply surged by roughly 40%, one of the fastest expansions in modern history. That surge wasn't wealth creation, it was leverage. And leverage without matching production has consequences. Why inflation didn't go away? When inflation peaked around 9% in 2022, the headline number grabbed attention. But the real damage wasn't the spike, it was the reset. Prices rose rapidly, then stopped rising, but they never fell. Groceries remained elevated. Rent hit affordability levels unseen in decades. Insurance costs surged due to higher repair costs and climate-related losses. Inflation works like a ratchet. It turns upward easily and almost never reverses. That's why official inflation numbers feel disconnected from reality. The increase slowed, but the higher cost of living became permanent. And now, with the Fed stepping away from tightening, the foundation for the next phase is already in place. The quiet pressure for more liquidity. The quiet pressure for more liquidity. Today's economy is sending a clear message. Households are stretched. Delinquencies are rising. Businesses are cautious. Government debt has climbed past $35 trillion. Interest payments alone consume a growing share of the federal budget. High rates simply aren't sustainable in a system carrying this much debt. At the same time, the Treasury must continue issuing bonds, and someone has to buy them. That requires liquidity. This is why QT ended, not because inflation was defeated, but because the system can't function without support. What comes next? Stealth easing. The next phase won't look like 2020. There won't be emergency checks or massive announcements. Instead, expect quiet interventions. Short-term Treasury purchases, adjustments to bank reserves. Technical operations framed as stability measures. The label doesn't matter. The effect does. More liquidity enters the system. Asset prices typically respond first. Stocks, real estate, and financial assets often rise before wages do. And that's where the pressure intensifies. Why most people fall further behind. As liquidity returns, asset owners benefit, but wages lag. Credit becomes cheaper, but essentials remain expensive. This is where the system quietly transfers wealth. High-income, financially disciplined households capture upside. Lower-income households pay through fees, interest, and inflation creep. Credit cards now carry average APRs above 22%. Buy now, pay later usage is exploding. More Americans admit skipping bills just to keep up with installment payments. The system doesn't punish recklessness. It punishes disorganization. And most people were never taught how any of this works. The everyday traps that drain wealth. While macro forces shape the economy, most financial damage happens quietly. Unused subscriptions. Frictionless digital spending, idle assets collecting dust, overpriced insurance, BNPL overspending, unreviewed bank statements. Each seems small. Together, they create constant leakage. In a high-cost, high-liquidity environment, these leaks become devastating over time. The reset is already underway. This isn't a future event. The Federal Reserve has stopped tightening. Rates are moving lower. Liquidity pressures are building. And the cost of living remains elevated. The system will keep moving, with or without public understanding. But awareness matters. Understanding how money is created, how liquidity reshapes markets, and how everyday habits protect or drain wealth puts you ahead of the reset. Most people will enter the next phase unprepared. You don't have to. If this breakdown helped you see the bigger picture, stay with the channel, because navigating what comes next requires clarity, not guesswork.